Good morning, everybody. Today is June 15th, 2021. We are halfway through the year. Wow, I can't believe we are halfway through 2021. What a year it's been. Today we have a market update for you called What's It Worth Today? It's a very simple valuation exercise. I hope you enjoy it. Thank you so much. We'll jump right into it. What's it worth today? A very simple valuation exercise. We'll jump right in with some really basic definitions. We're going to use Honeywell, which is a very well-run, a good company. We like it. We're going to use it as our simple example. But first, let's look at the metric that we're going to be talking about today, which is the PE ratio. Now, PE ratios is a very, very simple metric. A lot of people think it's too simple, that we can use as an indicator of whether a stock is overvalued or undervalued. Now, we won't get into the debate about the deficiencies and limitations of the PE ratio. That's not appropriate for today. But as an example, some people would rather use free cash flow rather than earnings as the divisor. After all, this is a simple division, price of the stock divided by earnings. So what is it? Price of the stock divided by earnings. For an example, ABC Corporation stock is trading at $100 per share. ABC Corporation's earnings are at $5 per share. $100 in price divided by $5 in earnings equals 20. ABC Corp is said to be trading at a PE of 20 or 20 times its earnings. Pretty simple, very simple. You don't have to be smart to be able to do this, which is a good thing. I wanted to throw in here, PE is so simple. It gets discounted a lot of times by serious people that are trying to value a company. But behind the PE, what the market is really doing is looking at the growth of earnings for companies, at what rate they're growing, the rate of change of growth. Now, remember that phrase, rate of change, for the growth rates. In other words, if a company is growing at 6 or 7%, all of a sudden it starts growing at 9 or 10% per year, we want to know that. Or if it's growing at 8 or 9% a year, and all of a sudden it starts growing at 6 or 7% a year. The rate of change, up or down, for earnings. You bump those against current and expected inflation rates, and the rates of change for inflation, the current and expected rates of interest, or the risk-free rate of money, or the hurdle rate. And the rates of change for all these. And all these variables are moving all through time. So it's simple algebra, but your variables are moving all the time. So a little bit of math there, not too tough. You get the idea. These iterations are the most basic elements of securities analysis. In other words, if you go to graduate school, you'll go over some of these ideas in mathematical form. That's kind of the first things you start doing, is you start going through the formulaic way of valuing companies. And then you get a little bit more complex with it. But the market is making these calculations constantly, and it's setting prices out in the market share in the form of people buying and selling the shares. Now, it's doing this constantly, setting prices constantly, prices constantly going up and down, if the market is allowed to operate on its own without artificial influence. And by this I mean, and if you followed what we've talked about in the past, by this I mean the Federal Reserve, the central bank, or government is not monkeying around with natural market price setting. The stock and bond markets are nothing more than auctions, constant auctions that are going on. If you've ever been to an auction, you get that. In this example, we're going to use Honeywell, good company. They've got about 690 million shares outstanding. This morning it was trading around $223 per share. Remember, price is constantly changing. Sometimes the number of shares outstanding can change. So this gives Honeywell a valuation at today's open, roughly, of about $154 billion. These are big companies. Sometimes people forget how big these companies are. But let's go to the chart. So in this chart, I know it's hard to read, but you'll be able to get what I'm trying to tell you here. This is a chart that goes back to
March of 2015, roughly. And I'm going to show you, it's hard to read that, I know. I'm going to show you what the PE ratios are through time and the earnings. What are the earnings doing through time? So in 2015, Honeywell was trading at about 16.6 times earnings. In 2016, it was trading at 17.2 times earnings. In other words, their PE ratio is rising. In 2017, it rose again at 18.2 times earnings. 2018 traded most of the year around 18.2 times earnings. So really did not get any big growth there in the PE from 17 to 18. 2019, about 21 times earnings. 2020, a little over 21 times earnings. 2021, now we're trading at 29 times its earnings. So we start here in 2015, 16 and change for the PE. 2016, 17 times its earnings, a little over 17. 2017, a little over 18. Fast forward, 2021, 29 times its earnings. Now, 29 times earnings is a very different thing than 16, 17, 18 times earnings. That is a big jump. So here's my hen scratch up here. You can see how much the PE is expanding by, roughly. The PE is expanding through time. And look, in 2021, the PE expanded by 36%. That is a big jump. Now, what did earnings do during that time? And remember, we're looking at earnings growth rate. 2017, they went up 5.8%. 2018, they went up almost 14%. 2019, they went up 1.9%. So not a lot of growth there in the earnings. 2020, earnings went down 13. And then 2021, expected, this is an estimate, you're supposed to go up about 13%. Down 13%, up 13%. Now I want to show you a couple of things. So if we fast forward to 2022, again, the market's always looking forward. It's really never looking backwards. 2022, looking forward to next year. We're halfway through 2021. They're supposed to make about a little over $9 per share. In 2018, the earnings were a little over $8 per share. So if you go back, that is $1.07 per share from 2018 to 2022. That's 5 years worth of time. So they're going up $1.07 per share. That's a 13.4% growth over that period of time, which is 5 years. That's about 2.6% per year growth. Not a lot of growth in earnings there. In other words, 2021, you can't see it. It's too small for you. We're basically going to earn about the same thing we did in 2018. So no earnings growth if we had used 2021. Earnings were flat versus 2018. Over 4 years, zero earnings growth. The only thing we had there was a dip of 13%, right? In 2020, we had a negative earnings growth. So rates of change, very important for forward-looking markets. Now, why did PEs expand 36%? Why did the PE from 2020 to 2021 go up 36%? Interest rates are down. That's one big influence. Interest rates are down. Interest rates are low, I should say. Interest rates are really low, historically low. Jim Grant, who I follow, as you know if you listen to these, he would tell you interest rates are at 4,000-year lows, and he would be correct in that. Interest rates around the world are extremely low. This makes, and they teach you this in graduate school, this has a tendency to make PEs expand. 16 and change, 16 times earnings, 17 times earnings, 18 times earnings, 18 times earnings, 21 times earnings, 21 times earnings, 29 times earnings. If interest rates are low, and they are, it makes PE ratios expand. Now, earnings in 2021, and we went over this a while ago, are the same as earnings in 2018. That's zero earnings growth. So did the PE expansion, was it because of earnings growth? No, it was not. We had a low rate of earnings growth. And we have been paying in the past 16 to 18 times earnings. Now we are paying 29 times earnings. So, this gives us caution. This makes us cautious. Now, this is for Honeywell, but you can do the same thing for the stock market. You can make this same very simple, very basic calculations for the entire market. This is just one company. You can do the same thing for all companies or an index like the S&P 500 or the Dow Jones or the NASDAQ. You can look at the rates of change in growth of earnings and also look at what interest rates and inflation are doing. Interest rates are low. Things that can make PE ratios not expand, but in fact contract, are inflation. Inflation, they will teach you, inflation can make PEs contract as well as interest rates. After all, in the end, when markets are naturally allowed to set prices, if inflation rises, this is tough on the bond market, and eventually, academically speaking, should make interest rates rise. So interest rates rising, inflation rising, those things can possibly make PE ratios contract. So what happens if we go, now we're at 29 times earnings? Honeywell, a good company, had been trading 16, 17, 18 times earnings. Now it's trading at 29 times its earnings. Pretty high. So what if we went back, instead of using, say, 18, let's use 19 times earnings. So if we use 19 times this year's estimate, we would be priced 32% below the price it's trading at now, right? The price would be 32% below where it's at now. If we use 2022 earnings, we would be 23% below where we're priced now. So the stock would be trading, if we use 2021 earnings, the stock would be trading 32% below where it's trading today, approximately. If we are feeling a little bit generous and use 2022 earnings, next year's earnings, we would be trading 23% below where we're trading now, given that it trades at a 19 times earnings. Now, 16.6 times earnings, 17.2 times earnings, 18.2 times earnings, 18.2, 21 times earnings, 21 times. So we're using 19, which is somewhere, in the middle. 19 times earnings at 2021 earnings estimates, 32% below where we are today. 2022 estimates, 23% below today. So yeah, gives us a little caution because we are now trading at 29 times expected earnings. So that is a simple valuation test on a very good company, Honeywell, that does earn money, is well run, and some people would say, well, it may be a bit overvalued now. It's trading at 29 times its earnings, and, that may be a little high, especially if interest rates go up and inflation goes up. So I hope you've enjoyed this. Just a very simple example of how to try to place a valuation on a company. Very simple, very easy to understand, and it's sort of the basic metrics, one of the basic metrics we use to look at companies and see where are they? What should it be trading at? What may it be trading at? Hope you've enjoyed it. Thanks a lot.